The time is now 10:02 and so we will begin. Welcome to the first half FY21 trading update for Janison Education Group. On the call today from Janison we have Mike Hill, the chairman, David Kaspari, the CEO, Sarah Rudner, Group Executive OECD PISA Test for Schools, Amy Baruch, Group Executive for ICAS Assessments, and Stuart Halls, the CFO. In a moment, we will begin with a short commentary from the chairman of Janison, Mike Hill, followed by a 40-minute presentation on the first half trading results and a business update. Following this, we will then open up the floor for any questions you would like to ask of the management team or the chairman. You may ask a question at any time by clicking on the chat icon within the Teams call. When we reach the Q&A section of this meeting, we will read each question out loud and the team from Janison will respond. A recording of this call will be uploaded to the ASX shortly after this call. I would now like to hand over to Mike Hill, Chairman of Janison Education Group, to give his commentary on the business for the first half FY21. Over to you, Mike.
Okay, thank you. Welcome everyone and thanks for joining us this morning. Really pleased to be sitting alongside the team here to deliver the first half results for FY21. And I'd just like to make a few relevant and important points. First of all, I need to congratulate the team for delivering such a good first half results. The business is truly becoming what it strived to become, which is a true SaaS platform provider delivering world-class digital assessments. So the business has really transitioned a lot over the last couple of years, and I think we're really hitting, our best, and there's more to come. Secondly, obviously, we're here to talk about the first half results for the year and a few relevant points to talk to in the first 6 months. Really pleasingly, the company more than doubled its digital assessment platform revenue, achieving over 143% growth. So that's an amazing stat there and really goes to the core of what the business is trying to achieve. And obviously that contributes to delivering group revenues of more than $16 million for the half, which was up 40% to the previous corresponding period. It also has generated positive cash flows, and again, it goes to show that the business is really hitting its straps. Importantly, the business, its newly acquired business, the ICAS Assessments business, delivered better than expected results. Congratulations to the team. That business delivered $4.8 million in revenue and over 80% in gross margin for the first reporting period. So that's a fantastic result for what has been a really positive acquisition for the company. And obviously, finally, these results and the delivery of what the team will talk to you goes to, point towards delivering shareholder value and returns. And we've seen a fantastic rise in the price. And I think what that means is that it gives us confidence that the shareholders see the business delivering what it said it would deliver, and obviously believes in the future for Janison. So really happy with that. So again, thanks all to the stakeholders that surround Janison in its digital education ecosystem, and obviously the team for its tireless work to getting us here. So I'm going to hand over to David and Stuart and the team to talk more about the business and its results. David?
Thanks, Mike. And I just want to say on behalf of the management team, thank you for the board for its advice, its guidance and its support over the last half. And welcome everybody to our first half business update. You're joining us here at our Janison New Sydney headquarters. And we're very pleased to be able to provide an update of the business this morning. Now, many of you have been following Janison for some time, but similarly, we've seen a significant lift in investors in the last 6 months. So for the benefit of our new investors, I'd like to provide just a little bit of company context. Janison exists to change education by leveraging digital assessments to measure knowledge and skills and provide insights for improvement. And we humbly consider ourselves a force of good globally. Our team consists of passionate educators, technologists, and change agents. And we're focused on empowering teachers, students, and governments to achieve better outcomes using our Insights digital assessment platform and instruments. Our assessments are authentic, they provide greater student insight, and they provide reliable data within a faster time frame. And our technology supports a commitment to equity and accessibility from all. Now, our history is as a regional New South Wales company, but we've evolved to an ASX-listed Sydney headquartered organisation, and we're now a trusted Edtech partner for universities, government, schools, accreditations, and educators around the world. Our focus is K-12, direct to schools, but also to governments, to parents and students. And we're now thriving on a global stage by delivering more than 5 million best-in-class assessments annually in 120 countries. To summarise, our focus is assessments, our focus is schools, and our focus is ARR. Our first half 21 has been very successful. I'm very proud of the business, the leadership team, and the momentum we've got. And I'm particularly encouraged by two key financial performance indicators, which really evidence our transition to a product-focused SaaS platform business. And that is a 70% assessment ARR growth year on year, and an increase in gross margins of 8.1 percentage points year on year. Now, at the beginning of the financial year, when we did our roadshow, we outlined 4 key revenue growth drivers that we were focused on that really would determine our success in FY21. And so at the half year, I wanted to provide a business update on these. Firstly, on ICAS assessments. And despite the impact of COVID-19, the ICAS competition in 2020 exceeded our most optimistic ambitions, delivering $4.8 million of revenue, and will deliver more than $5 million of revenue for the full year. The integration of the education assessment business from the University of New South Wales is also now complete. And as we close the first half, we've also successfully rebranded the business to ICAS Assessments. And ICAS Assessments is not purely limited to the ICAS competition. In fact, in Q4, we will be taking to schools the Reach Progression Tests. And that was also part of the acquisition in June 2020. Amy Baruch, our Group Executive of ICAS Assessments, will be speaking a little bit more about this business in a few minutes. Secondly, our partnership with the Organisation for Economic and Cooperation Development, the OECD, in the global rollout of PISA for schools continues to flourish, and we're very proud of the momentum here. It's a showcase of Janison's aspiration and purpose. It's got a strong focus on equity, got a focus on real-world learning, and our technology is what enables it to be accessible to all as we work to meet the needs of schools and of countries everywhere. This half, we bolstered our PISA for Schools capabilities, as we said we would, including the appointment of a PISA for Schools team. And we also appointed Sarah Rutner as the Group Executive for the OECD PISA for Schools business. We see that these investments will result in us rolling out the program in further countries in the second half. But beyond that, we also expect that we're going to be taking greater responsibility for the in-country delivery as the national service provider. I expect that COVID permitting, we'll be back on track to sign at least a country a month for the remainder of this year and into next year. And Sarah will spend a little bit more time talking about that soon. Thirdly, as we said at the start of the year, a key indicator of momentum in our assessments business is number of tests and number of candidates. And Janison delivered more tests to more candidates in the first half than almost all of last financial year. COVID permitting, we said we were going to deliver 5 million tests to 2 million candidates, and we will beat that for the full financial year. And finally, our partnership with D2L, which is a top 4 global learning management system provider, continues to build momentum. We've now completed integration of our Janison Insights platform with their Brightspace learning management system. And with the momentum we've got and the strong pipeline we've got, we are on track to begin to see revenue flow in the second half. So you can see on the right-hand side, we have 3 ticks against our 4 goals. And for D2L, I'm very positive that as we provide the next update, that will go from a plus to a tick. Some other areas that I wanted to highlight today that evidence the success and the momentum we have are as follows. Firstly, wanted to share the very successful delivery of the New South Wales Department of Education check-in assessments. This was an assessment delivered in year 3, 5 and 9. And it was a very unique assessment designed to understand the amount of learning that has been lost through to COVID. And over the course of the first half, we delivered more than 300,000 tests to more than 180,000 school children in the first half. And I think it'd be fair to say that this represented the most successful assessment in recent history, if not longer, for the New South Wales Department of Education. Secondly, we have now completed our build out of our sales function. It was something that we committed that we would do through the first half, and we're building strong sales momentum. We secured 5 new assessment customers and 3 new learning customers in the first half. And a particular highlight is the Chartered Accountants win, a $5 million TCV deal, and we will have started to see revenue flow from that and start to deliver assessments before the end of the second half of this financial year. In terms of higher education, we continued to support universities, government, schools and educators through COVID-19, including the University of London, and including SKIO, which you might remember is the entrance exam institute for the Czech Republic. And we're very pleased with the work we're doing, which includes remote proctored services delivered internationally. I will, however, call out our Janison Exam Management Services business, and it has declined and is expecting to decline for the entire financial year due to COVID forcing high-stakes exams, including those run by higher education, to be deferred or replaced temporarily with alternative forms of assessment. And some of those are assignments, some are low-stakes exams, but actually, we've accelerated the transition to digital offerings, including the ability for some of our GEM higher education customers to move to remote digital proctored assessments. Now, with the outlook for eased restrictions and a vaccination looking favourable, we do expect exam services revenue begin to return. However, the timing of the return is still unpredictable, and that continues to be an ongoing risk for the second half. So at this particular stage, at the end of the first half, I'd say we've completed the first phase of our transition to a product-focused SaaS business. We took the opportunity through COVID to invest to set ourselves up for global scaling. We've recruited significant new talent. We've accelerated the development of our platform. We've opened our Sydney-based headquarters. We've completed the rebrand of the company, and we've been rapidly maturing our processes, systems, and operations. I feel at this particular stage, as we look into an accelerated second half, we're well placed for growth at a time where thematically the shift to digital assessments has never been greater. I'm pleased with our performance in the first half. There are very strong macro signs and we have significant momentum. So as I now pass to Sarah, I want to thank our investors for their support as we continue on our mission. Sarah, over to you.
Thank you very much, David. So I'm really pleased to be here today talking to you about PISA for schools. Just by way of a little background, PISA, which you may have heard of, provides a system-wide satellite image of how education systems are performing, whereas PISA for schools applies a telephoto lens, telling individual schools how they're performing against a global benchmark. Janison signed an exclusive 5-year agreement with the OECD in April 2019, and we digitised their paper-based PISA for schools assessment and are now delivering it globally using the Janison Insights platform. It's a high gross margin business, and in financial year 20, we saw 7 countries sign, and we've got a really strong pipeline in place for the next financial year. Through the PISA relationship, we have a total market opportunity of 90 countries, and we're seeing strong interest from countries around the world looking to get their hands on gold standard data that's equated to the PISA scale to use in their individual schools. Participating schools receive a customised 85-page report, which, as I said, compares their schools' performance nationally, internationally, and against OECD averages. But more importantly, as an educator with 20 years of school experience, this is the only assessment in the world that brings together heart and mind, looking at the cognitive and the social emotional well-being of our students, aligned to the global PISA scale. It also, in financial year 21, will include the new global crises module, which is imperative data that our schools need to help address the learning losses and the emotional well-being of our students through the global health crisis. And as we look to how we can support schools as they return to school in countries like the US and Europe, we can help them address the learning losses and the impact on their students. So how do we grow the impact of PISA for schools? We formed an enduring and unique partnership with the OECD that I'm very proud of. And as we digitise and move to deliver in more countries, the USA, where we're also the national service provider, Spain, Portugal, Brazil, Thailand, Japan, Pakistan, and Russia, we're very proud of the work that we're doing globally to be a force for good. And in fact, as an excellent example, Janison was able to successfully deliver this test in 1,750 schools across Russia, across 6 or 7 time zones during rolling school closures amidst the global pandemic. And I think this is a testament to the strength of the OECD and Janison's relationships with ministries in country to deliver this assessment. So Janison is experiencing increasing demand with schools in countries faced with the challenges of the global pandemic, and they see the value in this assessment in supporting individual schools to help address and plan for the future. And with a strong pipeline in place, I'm very much looking forward to our next investor briefing, but I can share with you the names of the new countries that will be joining the PISA for Schools family. Thank you.
Thank you, Sarah.
Thank you. I'd now like to hand to Amy, who's going to update you on the ICAS assessments.
Fantastic. Thanks very much, Sarah. So for those of you investors who are new to Janison, in June 2020, Janison acquired the educational assessments business of UNSW Global, which incorporates, in addition to services, 4 proprietary assessment products. And we're very excited with the potential that we see to recover the pre-COVID historical revenue over the coming period. And now that those proprietary assessments are on the Janison platform, have the potential to achieve more than 90% gross profit. So in the 9 months since we've made the acquisition, we have successfully transitioned and integrated the business into the rest of Janison, including completing a full technology migration and realising synergies across almost every function across the 2 businesses. We delivered $4.8 million of revenue against our flagship ICAS assessment in the first half, despite the challenges presented by COVID-19 and against 3.5 million of guidance. In delivering that event, we delivered a seamless experience for our schools, students and parents, which we're really encouraged by. That resulted in an uplift in the school Net Promoter Score of 59 points and shifting it into positive territory, and also almost double the percentage of schools who stated their intent to buy the product next year, which we're really excited about. In the same period, we also rebranded the business to ICAS Assessments, including building and launching a new website in time for the start of the 2021 school calendar. So in terms of where to from here, we're really focused on 3 things at the moment. First is rapidly growing the ICAS competition as well as the other products, both domestically and internationally, leveraging the significant investment that Janison has made in sales, marketing and global partnerships. Second, we are enhancing and expanding the product proposition and experience. This is both expanding the suite of assessments and reports in our product suite, but also continuing to invest in a seamless digital test event experience end-to-end, because the more that we can take time and effort away from teachers, the more we can not only increase our share of the market, but we can increase the size of the market for digital assessments versus just paper-based assessments. And then third, we are transforming the business for profitable scale. When we acquired the business from UNSW Global, it's a business that over previous decades was really designed and evolved for a paper-based environment. We've already almost entirely eliminated paper from our operation, which has resulted in quite significant cost efficiency. But we are also pivoting almost all of our functions to be fit for purpose for a pure digital environment. And so with these three things, we are rapidly pivoting to a SaaS model, which we are anticipating is delivering, strong annual recurring revenue growth against a lean operation and a cost-effective take-to-market model. So thank you, and I'll pass over to Stuart for our financial update.
Thank you, Amy. Look, it's been a really good first half for FY21. We've had growth across almost all areas, and all of those growth figures have really exceeded our internal management expectations. And more importantly, I think the growth, has come from the areas where, we said we would focus the business for the long term. And this is in, firstly, one, assessments, where we've seen a 78% growth in annualized recurring revenue. And secondly, in platform revenue, where we've seen 88% growth in revenue. And then thirdly, in schools as well, where the acquisition of EA proved to be extremely positive, with almost $5 million of revenue in the first 6 months of the year at 80% gross profit margin. At the same time as this, the profitability for the business increased by 8 percentage points on last year to 54% this year for the first half of FY21. And I'll talk a bit more about this in a moment on another slide in depth as to why we believe this is likely to continue and onwards into future years. So on the P&L, I won't delve into the numbers in detail, but as I mentioned on the previous slide, Janison is delivering well on its key strategic objectives, which is to grow platform revenue. And the way in which we've achieved this is by A, adding new assessment clients to the core platform, B, expanding our existing clients, and C, through the introduction of ICAS in Q1 into the business. But it's important to note here that even without that acquisition of ICAS, the underlying assessment platform revenue growth was still very high at 49% on the prior corresponding period. The reduction in services you can see there is something that we've been expecting, and it will continue as we transition away from these long, complex projects to implement custom assessment platforms for our big strategic accounts, towards more of providing our off-the-shelf platform to global SaaS customers. Gross margin has increased, as I mentioned, by 8 points on the prior year, which itself was 20 points higher on the year before that. So we're seeing this continual increase in profitability over time, and the reason for that is a number of factors. One, the reason why the margin is increasing is because we are moving away from these sort of low margin services work to a more higher margin platform sales. Two, we're shifting away from our legacy or foundational clients who we produce custom assessment platforms for, to more of the new clients who are buying the core off-the-shelf Janison assessment platform. Thirdly, we're getting scale benefits from having much greater volumes of tests running through the platform. And finally, due to a number of permanent cost reductions in cost of sales from efficiency improvement programs. And I think the most important thing here to mention is that we expect all of these things to continue. We expect them to continue driving up the gross margin into the future. Just finally on OPEX, we said back in April 2020 that when we raised capital, we would invest in growing our sales and marketing teams to support the growth potential we saw in the market for assessments. Since at that time, we were very heavily under-indexed on spending in this area relative to some of our high growth peers. And those teams are now well established, the sales and marketing teams, and the impact is fully costed into the P&L in the final quarter of this first half. And that's obviously seen a step up in our OPEX cost this financial year, but we now have the capacity to deliver a much higher revenue number from that existing team. So for a moment, I just want to dive into gross margin for a minute and just talk about why we're seeing such a significant increase in our margins and why we believe this is going to continue. As I mentioned, the business has transitioned from having these very large strategic accounts with low margins to our new clients running on the core Janison assessment platform. Those older clients, the foundational clients, previously comprised almost all of our revenue in FY20. And then as we closed out the year, moved into this financial year, FY21, we now have more of our clients in revenue terms in the new category. And the reason why this is important is because those new clients typically generate about 2.5 times the profitability of our foundational clients. who, as a FY21 year to date, they're generating about 74%, and that's a blended average as well, versus 29% for our sort of foundational customer accounts. And as we continue to add more of these new clients to the Janison platform, we'll see a natural mixed benefit driving up the gross margin further, even from where it is today. And we'll also see scale benefits arise from greater test volumes coming through, which will support even more expansion of gross margin. Just in terms of cash and cash flow, so Janison is in a very healthy position. We have just under $10 million of cash on hand and no bank debt as at 31 December. For the first 6 months to December, we invested about $2.4 million in product development. Primarily, this was in the assessment platform, but we also invested in integrating the EA technology that we acquired from UNSW Global. In Q2 of FY21, so the final quarter of this half, we also invested, not a significant amount, but in material terms, a significant venture. We invested in building our first computer-based testing centre in Sydney, and that's within our GEM premises. So we now have the largest digital testing centre in Sydney, and we will be running the CFA Chartered Financial Analyst exams to begin with on these devices from as early as next week onwards. And we expect to see a lot more of GEM's clients transition from their traditional paper-based assessments through to a full digital solution via using these services, these testing services in Sydney. Looking ahead for the year, we do expect to see a negative net cash flow for the second half on a complete basis for the full year, but this is largely due to a seasonality of receipts, and the business is now capable of generating positive free cash flows on an ongoing basis. And as we grow into FY22 and beyond, we don't see any need to raise capital for working capital purposes. Yeah, that's how we're looking for the remainder of this year. So just moving on to the outlook, we aren't providing a formal guidance for the full financial year, but as you've seen throughout the presentation, we've given indications of where there are elements of the year to come or the remainder of the year. There is still a lot of volatility in the market as a result of COVID, and this is making it very difficult for us to forecast revenue, especially within our traditional exam management division of GEM. In saying that, however, there are some very strong positive macro signs which support our continued growth into the second half and beyond that. These strong factors are things like schools and universities returning to face-to-face teaching. Secondly, the disruption that has been brought about by COVID has actually forced educators and teachers to get more comfortable with and ultimately adopt more permanently digital technologies. And so this effectively creates a greater market for Janison and our assessment platforms and digital products. Thirdly, our relationship, Janison's relationship with leading educators around the world has actually never been stronger. As an example of this, the first 6 months, as David mentioned, we supported the New South Wales Department of Education to rapidly deliver a new check-in assessment to more than 300,000 instances, which allowed the department to measure what impact the pandemic had on students' learning during these shutdown periods. And finally, with PISA now fully resourced and a great relationship with the OECD, we expect to start or restart the signing of more countries and even exploring the potential to act as the national provider, take on that much larger role of PISA for schools in key locations around the world. And that's it. That concludes the financial update. So I'll now hand back over to Sonna, who will start the Q&A session.
Thank you, Stuart. We will now begin the Q&A section. If you have any questions, please click on the chat icon in the chat and type your question so we can answer it for you.
Thanks, Sana. So it looks like there's some questions coming through. The first one here is, when do we expect to be cash flow positive? We are technically cash flow positive. We're obviously reinvesting some of that money back into product development at the moment, but on a full net cash flow positive basis, we expect that FY22 will be a positive cash flow situation. So that's that.
I think the next question I'll ask Amy to respond. What is the current NPS for ICAS assessments? You mentioned it flipped to positive.
Yes, so previously it was less than -60 based on last year's digital event suboptimality, but it's now moved into the positive territory, +2 for schools, and also positive for parents as well, which was the first year that we tested for those.
Wouldn't underestimate the significance of that in being able to build a platform for the future as well. You know, what schools wanted was an exceptional customer experience. You know, they had previously not had that experience, and so it set the foundation for Reach and for ICAS for the future.
This one,
yeah, I might ask Sarah, and then if there are some maybe a comment on the financials.
So the question is, could you please explain the significance of being a national service provider for a country? An example would be great. And maybe if you want to just explain the sort of qualitative, and I'll talk about the sort of financial.
Yes, certainly. So we're at the moment we're the international platform provider in countries, meaning we deliver the platform for an in-country provider to deliver direct to schools. Where Janison becomes the national service provider, we develop direct relationships with the schools to deliver the test. So we maintain still with the OECD relationship with the PISA for schools content, Janison as the international platform provider, but then also as the national service provider, onboarding schools, setting schools up to take the assessment, training schools to deliver the assessment, working closely in alignment with every school that sits the assessment, and then delivering the reports and the post-assessment workshops into their hands.
Cool. Thanks, Sarah. So I think, you know, just on a financial basis, so there's a sort of IPP or the platform provider offering to a country where we simply give the keys to the software to each country, and that's happening in a lot of countries at the moment. And that's a sort of fixed $100,000 per annum recurring revenue. That's at good margins. The national provider sort of opportunity is much larger, and what we do is, as Sarah was saying, we take on a full role of sales and marketing within country, as well as the onboarding and everything else. And for that, we charge a per school fee, and that's about $7,000 per school. And so, you know, if you can imagine, the way in which to size that market is to simply look at the number of secondary schools in each country that we're going into, and multiply that by 7,000. That's the opportunity. You know, obviously there's a means of getting there through some sort of reach or through channels, but yeah, that's the sort of total addressable market size. And I think where it makes sense is probably in those English-speaking countries where time zone as well is favourable for us. But that's certainly something we want to be exploring as well. We are exploring quite carefully.
I'll take the next one. David mentioned the conversion of a new PISA country each month. When did this start? I think it's fair to say it starts imminently. I think the thing to note is that because of the complexity of some of the commercials with the OECD, but also with countries, determining the exact week or month is actually quite tricky, and so you can see it being a bit lumpy. My confidence that we're going to monthly is actually a confidence of 6 for the next 5 or so months, and the timing is going to just be a little bit unpredictable, and that's based on the pipeline we've got, the momentum, and actually the commercial conversations that we're having.
Next question. So is it fair to say you think you have sufficient cash to develop and grow the business, and would you only capital raise for acquisitions? Yes, is basically the short answer. We do have sufficient headroom for ongoing growth, and I think, you know, that's a pretty rapid growth as well, so we are investing in headcount to do that, but we see no need to raise capital for that, and it would only be if there was an acquisition. Yeah.
The next one is, who are your greatest competitors and why? Look, I'm not going to name specific names. What I'll do is I'll break it down into a couple of segments. And firstly, you know, there are a number of publishers globally that have developed a set of schools products, you know, that compete in some ways with our ICAS assessment products. Our ICAS products are highly differentiated, and so it's very difficult to do an apples for apples comparison. There really isn't anything like the ICAS competition in the marketplace. I'd also say that in the schools product space, we are largely competing with organisations that are still on legacy paper-based, as opposed to have made the shift to digital, and so that allows us to scale more quickly and more globally. On the assessment platform side, it's actually a different marketplace, and obviously we put our products on our platform, so it's a full stack. But we also provide the platform for other organisations to author their assessments. There are a small number of global players. I'd put it at less than 6. If you really understand that what we do is high stakes, high volume, when you look at doing hundreds of thousands of simultaneous assessments where it really matters, university entrance exam and so on and so forth, you can count it on a single hand. The last comment I'd make is we're not competitor focused because we're not in any way market constrained at the moment. Our actual challenge is focus and to be very clear on the markets at which we want to compete, because we know that we can compete and win.
Thank you. Next question is, just noting the GM percentage for ICAS is seasonal. Could you please give us some idea how gross margin will be in the second half? It's not so much that seasonal, it's more that the revenue falls in the first half, predominantly for ICAS, but we do have other ICAS products and school products being sold in the second half, not to quite the extent of the first half. But long story short, we don't expect any contraction in the gross margin for the second half on the first half.
I'll take the next. For US expansion, will Janison set up a base there and plan to grow more types of tests like SATs? Look, what I'd say is I'd answer it in 2 ways. Firstly, the D2L partnership with the Brightspace Learning Management System really opens up markets like the US, where we are integrated into their Brightspace platform, and that's very much D2L is very much focused in the education space and the school space, so it's very well aligned. In terms of expansion of our schools product, in terms of the OECD PISA test for schools, for example, we are the national service provider for the US, but we've made the tactical decision to partner for the delivery. We're very cautious about scaling direct OPEX into very large international markets where we don't have deep existing relationships, and there are players in, for example, the US that have significant breadth and reach that see the differentiation of our product. In terms of the ICAS competition, we're still working through the details of which markets we're looking for, but you can expect that we will expand globally.
Another question here. Can you please remind us of the cost threshold to see 90% incremental gross margin in the ICAS business? It's a really good question because for those who don't know, the way ICAS works is there are a team of test writers here in Janison who source and generate the questions every year, and that obviously has a cost. And then the test is delivered to any number of students, regardless of how much we've spent. And so in the past, that number has been around $4 to $5 million. Of cost to develop the test. That's developing, sourcing, refining, designing the test, and uploading into the Janison platform. And so anything above that is obviously pretty much almost 100% gross margin, with the exception of a little bit of variable costs for things like hosting. So around the sort of that 4 to 5 mark. The reason why we generated 4 to 5 million in revenue this year and still made 80% is because we inherited the questions from, or a lot of the work and pre-work had been done by UNSW just prior to acquisition. So we purchased the business just after the test had been sort of produced, and then we kind of did the delivery and accepted all the receipts.
Look, on the next question, what would you say is sustainable competitive advantages over your competitor? Do you have any clear points of difference? Could you give us some colour around this? With thanks. I'd break it into 3 pieces. I'd break it firstly into partnerships. Our relationship with the likes of the OECD, with the likes of the British Council, and with the likes of the Department of Defence are candidly as deep and as authentic as any I've seen in my career. They're not vendor partnerships. They are truly interrelated and interlocked. And I think that's largely anchored on the fact that while we're an EdTech company, at least a third of us are educators. And so we understand deeply how to engage and add value. The second is in our schools product is product differentiation. Don't underestimate what 40 years of developing the ICAS assessment does to developing a world-class product and enormous loyalty. We saw 2,500 schools this year run the ICAS competition, and we expect that to lift post-COVID as people come back on board. And in our assessment platform, the work that we did, while Stuart shared the transition that we're making to a standardised but configurable platform business from a customised, don't underestimate the work that we did when we initially worked with the New South Wales Department of Education on an assessment platform, when we then enhanced it for NAPLAN with all of the capability to protect from global threat actors and the scalability, and then the work we did in Singapore to generate the millions of lines of code, the resilience and the configurability. It makes the barriers to entry at the high stakes, high volumes, very, very high. They're the 3 points I'd make.
Next question. I know the platform gross margin is 75% and new client margin is higher than existing. How do you see the gross margin percent evolve over the next 3 to 5 years? Yeah, a really good question. Look, I mean, we do have a business which is sort of a blend of different things, and that's foundational clients, it's new clients, it's services, and it's platform. But as we grow and we continue to grow, our business will become primarily schools platform revenue on our assessment platform. And as it does that, you can expect that we'll be generating gross margins of a typical SaaS company. We've heavily invested in the product over the last 10 years, but we now have a very solid product that we're selling as an off-the-shelf core platform, not customized, but configurable, and therefore we should be able to generate those high SaaS margins. The time in which we get to that place, and we're talking sort of 80s and beyond, the time in which we get there is probably within that time frame that you've suggested, within 3 to 5 years, between where we are now at 54 up to that level over time.
And I'll remind you if anyone has any final questions. Thank you for these questions. They're very insightful and really sort of evidence that people understand our strategy and direction. So that's encouraging. Any final questions? Well, if not, I'll pass back to Sana.
Okay, thank you, David. One coming in.
What is the current growth strategy for the learning business? Good question. Thanks, Alex.
Well, let me cover that off. Look, we see our core future, as I described, focused on assessments, focused on schools, and focused on annual recurring revenue. That said, we have a very strong and loyal existing customer base, and we signed 3 new additional customers in the learning space in the first half of this year, and so it demonstrates that in the right segments, the product continues to be strong. We see single-digit growth in the learning space. It's a far more saturated market than the assessment space, which is very much unconstrained from a marketplace standpoint. We know that we need to continue to refresh the product, and so we are putting enhancements in place, including LTI, including Teams integration, and including the enhancement of our user experience. And I can say, well, when that's brought to market, people will be very, very excited by its look and feel. In terms of where we will focus, we have brought a new leader into lead the learning business, and we've asked him with the leadership team to think very hard about clarifying our market segmentation. We don't want to seek to compete and win. Broadly across the marketplace, we see parts of the mid-market in particular as being very compelling, as well as our social learning platform. We've been running a campaign over the last, a digital outbound campaign in the last 3 months on the social learning platform. Without going into the details of the inbound leads that we're nurturing and the leads that have gone into sales, we're encouraged that we'll be able to bring new customers on board.
Cool. A couple more questions here. So I know guidance is difficult, but can we expect 30% plus growth in the second half? Look, it is really hard for us to pin down. I guess the market is moving around a lot, and our GEM core business is a reasonable amount of revenue, and that fluctuates. Or as it fluctuates, it makes it very difficult. But I think 30% full year is not outside the realms of possibility. I think as long as the world doesn't significantly deteriorate, I think it's achievable. But I'm not sure that we would give that guidance at this point.
What are the greatest threats to the business? Look, I think let's setting COVID aside. If I was to break it into market and execution, I don't think the market is constraining us. I feel like our strategy is clear, which leaves execution. I think that we have to be very careful about being a victim of our own success. The business is scaling fast and it's coming to us quickly, and we're transforming the business very quickly. As you can see, what we've done in the last 6 months. But as we look into next year, we look into what we're seeing in the schools business. We look at what we're seeing in PBTS. We look at the pipeline in our assessments. Sorry, PISA for schools. I apologise. We look at our assessments business. It means we're going to need to transform even faster, and so that's the task of the leadership team.
So what is the relationship with the current service providers for PISA tests like BNSA or BNSI in Japan? And are there plans to do more tests with them complementary to PISA?
Yeah, certainly. So as we mentioned, we're the international platform provider for Japan, and then BNSA are the national service provider in Japan. So we've got the first test window actually happening at the moment, and there are plans to do more work with the PISA for schools assessment with BNSA.
Yeah, I think it's a really good question. We do see an opportunity. There's obviously the concentration risk potential, but I think we are seeing discussions happening, and that would be our plan to move off PISA in that country and in all countries as well, expand where there's opportunities to do so.
Absolutely.
Cool.
Any final questions? If not, I might make some comments. Firstly, I just want to once again thank our investors for the support, the board for its support on the journey. Our partners that matter deeply to us, like the OECD, the British Council, the New South Wales Department of Education, and so many others. And I'd like to thank the executive and every member of Janison for its commitment, its support. I'd hasten to say that, this is an extraordinary point for this company. I feel like we've set the foundations strongly. I can see the momentum in all of the leading indicators, and I hope you can see through evidence in the first half and with the announcements we've made that our execution strength has significantly lifted. The second half is going to be a very important half for us. We're going to run more assessments between now and the end of the year than at any other time in Janison's history. So it's an exciting time for us, and we're going to have to execute well. But we continue to be very optimistic. The thematics of this space are strong, the momentum is strong, and we look forward to continuing to support this business through the second half. I'll pass you, Sana.
Thank you, David. That now concludes the Q&A section and also this investor briefing. Thank you to everyone who attended. A recording of this call will shortly be lodged on the ASX. The meeting is now closed.